So what's happening in the world of real estate? Well, let's find out. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate. We help people buy and sell homes, whether primary, secondary, vacation homes, or investment properties. And we'd love to be able to help you. So if you're watching these videos, please subscribe, click the like button, hit the notification bell. And by the way, also, please share these videos with your friends, your neighbors, your colleagues, your family members, anyone you think might benefit from having really important information. So let's go ahead and dive in. And as regular viewers know, every month I like to give a little bit of context to what's going on behind the real estate market so you can understand the numbers better, right? The things that are actually impacting sales or transactions, as well as listings and prices in real estate. So for the last several months, what I've been highlighting is obviously there's a Trump war. And I'm highlighting that because it does a couple of things. It's creating a couple of things that are impacting the housing environment. And those issues are becoming maybe even more consequential right now. So issue number one is it creates a lot of uncertainty, right? And we've already got a lot of uncertainty in the environment due to upcoming elections, due to constant government shutdowns, due to changes in immigration law and enforcement patterns that are happening left, right, and otherwise. You know, the changes in what's actually going on in DC and whether or not the White House can be bulldozed and things like that, right? A lot of uncertainty in the environment. Well, this war is exacerbating uncertainty. But it's doing more than just that, right? It's not just simply, as the University of Michigan Consumer Confidence Index shows, consumer confidence in the US now is actually at the lowest level it's been since the pandemic, the onset of the pandemic. Consumer confidence is definitely weak, and that's because of uncertainty. But more than just that, we're starting to see very real impacts on inflation, right? Because with the Trump war, we've got the Strait of Hormuz at least largely closed. And that means that 20% of the world's crude oil is not transiting through the Strait of Hormuz, which means that energy prices are way up. The same thing is happening with fertilizer, right? So fertilizer ingredients, if you will, many of them are also produced in and around the Persian Gulf. And so those products need to get through the Persian Gulf in order to be able to get to the world market, to be able to serve farmers, right? And here we are in early June, on June 7th, as I'm recording this, and this is high planting season, right? And so farmers are going into the planting season without the appropriate fertilizer stocks, meaning fertilizer prices are very elevated. Obviously, also refined products from crude oil like diesel fuel, very elevated. And so costs for farmers are going up considerably. Where does that spread? That spreads into the so-called food basket, right? All foodstuffs require diesel fuel for growing and transport. They require fertilizer, right? Even if you're raising cattle for the market, you're still using fertilizer because you've got to grow all of the food that the cows eat, right? And by the way, now we also have a new screwworm outbreak in Texas, which is going to be further impacting beef prices. So if you thought beef prices were going to be coming down, no, they're not. They're going to be continuing to go higher and higher and higher. Okay, so we've got the war is causing oil prices to go higher, which is causing cost of transport for everything to go higher. And we've got fertilizer prices going higher, causing all foodstuffs to go higher, right? So this Trump war is now feeding not only inflation, but an increasing inflationary trend. Well, what does that mean? That means that the Federal Reserve, in its desire to keep inflation at about 2%, is now looking at inflation that's approaching 4%, double their target, and they're going to have to decide, or do they actually increase interest rates to try to fight inflation? Well, what about the speed of the economy? In Q1, the growth of the overall economy was 1.6%. That's considerably below trend, and especially if you think about the makeup of growth in Q1, a lot of it was sort of the capturing back the deficits that we had in Q4 of 2025 because of government shutdowns. So Q1 growth was weak, right? So overall economic growth is running below trend. So the Fed might want to spur economic growth. But we also have unemployment numbers, and unemployment numbers for the past 2 months, I'm going to go out on a limb and say they've been significantly manipulated. You may remember last year, the Trump administration actually fired the people at the Bureau of Labor Statistics who were in charge of compiling the unemployment numbers because they were reporting numbers that were looking bad. Unemployment was going up, the employment levels were going down, job creation was going down, and the people there got fired. Well, for the past 2 months, we've seen the employment numbers in the US increase both months by about 175,000 jobs, which is more than double what the private expectations had been. Where do private expectations come from? They come from looking at payrolls, they come from looking at traffic on streets, they come from a variety of sources, right? So the government is likely starting to fudge the employment numbers. And interestingly, in doing so, they're making the economy, according to the official numbers, look stronger. And what that does is it makes it harder for the Federal Reserve to justify any kind of rate decrease because the economy is strong and growing because employment is increasing. Now, we'll end up finding out whether or not these numbers have been cooked as we go through time, right? There's ways in which we can see this. The economy grows or it doesn't grow, right? If employment's going up and the economy is shrinking or not growing, that means productivity levels are going way down. We have growth in certain parts of the economy, undoubtedly, but it's right. If all of the private economists are coming out with estimates, the ones who specialize in making forecasts on macroeconomic data, specifically employment levels, if they're all coming out saying 2 months in a row, hey, we've got like 70 to 85,000 jobs growth, and both months the US government is coming out and saying, no, we've got 175,000, that's looking really suspicious. So what does this mean then for interest rates? Well, the Fed will be meeting next week, as I record this again on the 7th. They'll be meeting next week, and they'll be having a meeting to decide what they want to do with the policy rate, the Fed funds rate. They could, of course, cut the rate to spur economic growth, but that would induce even more inflation. So that would be contrary to their inflation fighting skills or goals. They could raise interest rates in order to tamp down the inflationary forces that we see emanating out of the Trump war. But that would actually induce slower growth and probably lower levels of employment. And so this is what I had described over the 2026 market forecast and a few other months around then, when I was saying the US economy is likely going into a stagflationary environment. And that is a period of time where growth is below trend, below carrying capacity for the economy, perhaps negative, not necessarily, but below what the economy can actually sustain. At the same time, the inflation is elevated. So we literally have that scenario right now. The question is, does it become worse, where we get higher inflation still and further below carrying capacity on the economy? It's likely we could actually tip into a recession here. I will say here in Las Vegas, we've noticed over the past 3 or 4 weeks, 3 weeks, I guess, the amount of traffic on the road has dropped significantly. The number of people in restaurants has dropped significantly. And so I think that in Las Vegas, we're starting to see an actual real slowdown in the economy, right? Not just in real estate, we'll get to in just a second, and in tourism, which we've been seeing, but I think it's metastasizing across the entire Las Vegas economy now. Not all local areas grow and shrink at the same time or at the same pace across the nation. Las Vegas could be a canary in the coal mine, a leading indicator here, but I think that we're actually starting to see actual recessionary forces here in the Las Vegas area. Okay, so let's dive into the actual statistics now. And let me again comment, I pulled the data on the 7th of June because I pull the data every month on the 7th so that I can see the most complete picture possible for the prior months. Some data still will not have hit the data sets that I pull from. Most will, so this is pretty stable on the 7th. But if I pull the data prior to the 7th, we've got just so much variability coming into the data set that the numbers themselves don't actually give us a very good indication of what's going on. They're just not stable enough. Okay, so recorded on the 7th after having pulled the data on the 7th, but I'm looking at the prior month. Single family residential for May of 2026, median sold price, $479,500. Now, this is interesting, right? This is up $14,500 from the month prior, from the April data, or it's up 3.1%. It's also up 0.9% year over year. Now, I want to comment on this number 479,500. We have only twice in the history of residential real estate in Las Vegas, right, which is the history of Las Vegas going back to 1904, have we seen prices that actually were higher than the 479,500. And that was at 480, and it's happened twice. It happened in May of 22, and it had happened one time prior. Okay, so here in May of 2026, we reattained approximately 480. We're 500 below. Now, last month we had been at 465, and I had commented last month that we've been in this range actually for the past 4 years, trending between 465 and 475. We're kind of on the top of that range right now, just a little above at 479. Do I think that prices are going higher? I don't know, they could be, but we certainly do not have a trend. We have a range, a durable range that we've been putting in place for quite some time, and we're fluctuating within that range right now. We've broken out on the high side, but we don't know that that's actually a sustainable breakout. Now, I want to point out to you, we went up $14,500 month over month from April through May. That means if we annualize that gain, so we took that 14.5 and we multiplied it by 12, that would be an annual gain of $174,000. That would mean that we're growing, right? In May, prices grew on an annualized basis at 36%. Now, I point that out because I want you to recognize that gain that we had in May is likely not sustainable. It's not healthy, right? So what we're seeing is either we're just bouncing around within this range that I've noted to you, or we're seeing something else, which is an unhealthy indicator in the market. And that is we're seeing degradation in some portion of the market and gain in another portion of the market where that gain is on the upper end and it's escalating into what in the stock market is frequently called a hockey stick pattern, where we get sudden increase, very large, over a short period of time that usually represents a market blowout on a market top. Again, we don't have a trend here. We have a single month of data. So I'm highlighting this to you as there could be a little bit of concern. It's something that's background. It should not be worrying you at the moment. But if we see 2 or 3 or 4 months of this significant gain, that's actually a really unhealthy indicator for the overall housing market. So we want to pay attention to this. Pricing is always interesting, but a movement of this level is something that we want to pay attention to going forward. Now, I'm going to make another comment about that in just a minute, but first I'm going to tell you about condos and townhomes. Unlike single-family homes, condos, the price was flat at $225. Okay, so April 225, May of 225, but we're down 9.6% year over year, right? So clearly we are not within a bound range in the condo market. We've got some significant fluctuation. We're down almost 10% from the top. That's not an overall deterioration in the market, but it is noteworthy that the condo market has been behaving weakly over the past multiple months. Okay. Now, this is not actually further deterioration from what we had seen in April, because again, prices are flat April through May. So that's good. It represents some stability in condos. I don't know that things are going to further deteriorate, but we do have this, this bigger drawdown on an annual basis. What about townhomes? Townhomes 329 were down $1,000 or 0.3% in townhomes from April to May. So again, that's generally stable. We are down year over year, 3.2%. So they're not a particularly big decline, but that suggests that actually townhomes are still within a durable range. We're fluctuating within that range. We don't have a trend up or down, but we're down a little bit from where we were last year. Now, the insight that I want to give you is with regard to pricing overall. Now, those of you who watch my videos every month, you know that I also look at price per square foot. And the reason I do that is because if we see changes in price per foot that are different than the changes we're seeing on sold median, then what that tells us is there is either weakness or strength in the upper and lower ends of the real estate market. So in single family residential, while prices had gone up by 3.1% at the median, price per foot did go up. It went up 2%. So that's not showing huge strength on the upper end of the market. It's actually kind of statistically, given the overall numbers, within line. So I don't think that we're headed towards some blowout, some hockey stick pattern on pricing. I think rather what we've got is some randomness that snuck into the numbers in the month of May that will probably move sideways or down slightly back into the range we've been seeing as we go through the month of June. Now, I will tell you prices for townhomes up at the median price per foot. Interesting, suggests maybe the upper end of the townhome market's doing a little bit better than the lower end, and condo is actually flat, which is interesting because that's exactly what we were on the median sold price for condos as well. Okay, so that's what we look like for pricing. We've moved to the upper end of the range, slightly above it for single family, where we're not really in a range bound area. For condos, we were flat, but we're low compared to last year. And townhomes were within a range. We're a little bit on the lower end of that range, but we're within the range. So next statistic is our demand measure, which is the number of sold units, the number of completed transactions. So over the past couple of months, I've been telling you we've got really unhealthy conditions materializing into the marketplace. And we've been seeing that through the spring selling season with regard to a number of the metrics. Well, let's look specifically at the first of those metrics. And then, of course, we'll go and look at the others as well, because the unhealthy attributes of the market are continuing and they're not getting better. Single family residential resales, 1,854. For the month of May, that's down 88 from the month of April, or down 4.5% month over month. Right? We're also down 3.8% year over year. So single family residential transaction volume has come down. It's weak and it's come down further in May, right? And May should realistically in Las Vegas be one of the very hottest months for resales, right? It's before it gets to be really hot for weather. People are looking through the spring selling season. May should be one of our very strongest months, and sales came down. And I want to point out to you that the number for May for single family residential is below the 2023 level, it's below the 2024 level, it's below the 2025 level. Here we are through 5 complete months of residential resales on the calendar in Las Vegas for all submarkets, but for single family right now as we talk about it, and we're down relative to where we were last year and the year prior and the year prior, right? And last year we were the lowest number of transactions that we'd seen in the Las Vegas Valley, going back to like 1974, right? A long time ago on a per capita basis. Okay, so what about condos? Any better there? Well, 214. We're down 7 condo sales in May relative to April. Again, the strongest month of the year typically for resales, down 7, down 3.1%, and we're down 11.9% year over year. Condo sales weak, right? And we're below 2023, 2024, and 2025 on condos. Okay, well, was it better for townhomes? Townhomes, 241. Down 14 or 5.5% month over month. That's not good. We are up 0.8% year over year. And what that actually means is we had 2 more townhome sales in May of 2026 than we had in May of 2025. We're below 2023 levels, we're below 2024 levels, and we're basically flat, right? We're up 2 from the 2025 level for townhomes, okay? So transaction volume, not only was it really weak last year, it's even weaker this year, right? I mean, that's just the reality of it. That's the actual market. Now, it doesn't mean the market's collapsing, right? And we'll talk more about the unhealthiness as we go through this, but it means that transactions are really slow, right? The level is really low. Now, I do want to point out pending sales, right? Sales that we might expect to see close next month, meaning in June, up slightly, not a lot, up in all submarkets. So we could get some strength relative to May. We could get some strength in June. I do want to comment though, pending sales had been up in March and April and now obviously May. And in March and April, we saw sales go down, right? Relatively speaking. So there's no guarantee this is actually going to be strength in June, but at least it looks a little bit better than the actual sales numbers. So I do want to point that out to you. And the overall total for 2026, if we put together all segments, 2023 and 2024, we're slower than those months. We are up 1.9% in the global sales category from 2025. So 2025, again, the weakest in 50 years on a per capita basis, we're up 1.9% from that. So maybe that's comforting. Before I get to supply, which we will in just a second, I want to point out one other thing, because this is kind of interesting. The number of townhomes sold in May, 241. The number of condos sold in May, 214. So in Las Vegas, the townhome market is smaller than the condo market for a lot of structural reasons, including there's a lot more condos than there are townhomes. This inversion, more townhome sales than condo sales, really unusual, right? So at May of 2026, townhomes were the second largest submarket, right, after the very much bigger single family residential. So suggests some additional weakness. I'm going to phrase it that way, as related to condos. Okay, so prices were flat. We're going to look at more data on condos, but we're down 9.6% on condo prices year over year, and the condo sales that took place in May of 2026 below the level of townhome sales. So I don't think it's actually strength in townhomes, right? Because townhome sales were only up by 2. I think it's actual weakness in the condo market that we're seeing spreading across multiple of the statistical indicators for condos now. That's something specifically to pay attention to. Okay, so now let's turn our attention to supply, right? Inventory, right? We've got demand. We know what's happening on the buy side of the market. So let's look at what's happening on the seller side of the market, the supply or inventory numbers. And this is not good either, right? This is actually more indication of unhealthiness. Single family residential supply, number of homes on the market at through the month of May, 6,885. That's down 185 from April of 2026. It's down 2.6%. And again, May should be one of the strongest months of the year, and we've got inventory coming down. And by the way, it's not coming down because everything's being bought off of the market, right? Because sales are down too. So it means that either things are expiring and just not coming back into the market, or perhaps they're going into contract and then, they're sitting there as pending and maybe failing. We'll talk more about that in a couple minutes. Or it may mean that sellers are just simply frustrated and they're saying, you know what, I'm taking my property out of the market, I'm withdrawing it, right? And if I withdraw it, it's no longer sitting in inventory. And by the way, we're down 10.4% year over year on inventory of single family residential. And I'm going to comment more about that in just a minute because it's a significant thing that I want you to pay particular attention to. Condos, 1,619, that's down 22 or 0.7% from April. So again, we should be, holding inventory or building inventory, and we're down. We're down 9.2% year over year. Okay, interesting. Townhomes, 1,103. That's down 48 or 4.1%. And I'll just point out here in light of the note that I had just made, we've got 500 more condos for sale than townhomes, right? That's about the right proportion. So it's not that we have an excess number of townhomes for sale. It's that we have the appropriate relationship between townhomes and condos here on the inventory side. The real weakness on the demand side is what's showing and caused that inversion between townhomes and condos when we're looking at demand. Okay, down 48 or 4.1% month over month, and we're down 3.4% year over year. 2 insights with regard to inventory. All submarkets have now shown sequential, slower year over year inventory growth for 13 months. And in fact, we now have 2 months where every submarket is showing actual decreases from the prior year, right? Because we'd had this inventory blip in 2025, the earlier part of 2025, and we've been working through that every single month. And single family had gone below 2025 a few months ago. Condos had gone below 2025 in April. We see that now in townhomes. Every submarket inventory, and this is only listed inventory has gone below year ago levels. So we're actually shrinking inventory in the market, not just relative to where we were last year. We're growing at a slower pace. We're actually shrinking inventory in the marketplace. And insight number 2, new listings. New listings for each submarket, single family, condo, and townhome, dropped in May relative to what they've been in April, right? Significant drops. So we're not going to see a lot of inventory flooding into the market in June. We're probably going to see the same kind of inventory structure throughout the remainder of 2026. And if you go back and look at my 2026 market forecast video that I did in December, you're going to see that this is what I was suggesting was we're not going to see big floods of inventory. We may actually see like flat or maybe even negative inventory. We're not going to see big increases in transaction volume in 2026. We're going to see maybe flat or maybe down transaction volume. Actually, I said transaction volume in 2025 has been so slow, we're likely to be up a little bit at least in 2026. Yeah, so these are the predictions I've been making half a year ago. And by the way, I will say there's now a couple quote unquote forecasters who've now marked their forecasts in the May, June timeframe of 2026 for the remainder of the year to look like what I had been saying in December of 2025, right? So my forecasts have been pretty spot on. Okay, now I do want to comment, some months divide inventory into fake and real. I've not redone that analysis for May, but you'll remember in April, we saw that inventory at the median was priced $116,000 too high, which meant that 52% of the stuff sitting in inventory was fake. So price for single family has gone up by $14,500. That lowers the size of the gap, right? But we're still more than 100,000 too high, assuming that the listed numbers remain the same as they were the month prior. So we still have most of the inventory, or very much of the inventory sitting out there is fake. And that means that we're looking at below 3,000 actual single family residential properties priced properly into the market as real inventory. We're still below 30% of actually normal inventory in this market. Why is demand down? Because buyers who might be looking can't find what they're looking for. So they're not transacting on it, right? So this critically low inventory is a problem. And by the way, this is one of the reasons why we might see, even though transaction volume is going down, prices go higher. It's because when somebody does find what they want, they jump on it, they make the transaction. And so, there's demand out there. There's actual demand out there competing on very little product sitting in the marketplace. Okay, the one other statistic that I've been giving every month since October of 2020, and that is the backup market, which I use as the proxy for contract failures. Remember, a contract fails, it falls out, and the house may drop out of the market or it may be relisted. Most, not all, but most of the product that drops out of contract will be relisted. I don't know the size of the gap, the ones that do not relist, right? So this is the best proxy we have. It's an undercount. The undercount might be just a couple units. It might be a couple percent. It's not huge, but it's significant to let you know this is actually an undercount. Single family, 681 contract failures in May. They went back on market. That's a 26.9% contract failure rate with the unknown but slight undercount. Condos, 112 contracts failed and went back into the market. That's a 34.7% of contracts on condos failed. So not only were prices flat and sales down, but we had more than a third of all condo contracts failed, right? Literally. So you thought you sold your condo, 1 in 3 chance, you didn't. You thought you bought a condo, 1 in 3 chance, you didn't. 34.7%. Horrible, horrible, horrible numbers. Townhomes, 86 failed, went back into the market, 26.3%. So it's only 1 out of every 4 townhomes, or 1 out of every 4 single-family residential contracts that are failing, right? These are really horrible numbers, and there's a variety of reasons for them. Talk to your agent to find out what's going on and how you can protect yourself about this. And by the way, our contract failure rates at Chong Miller Group, well below 1/10 of this level, right? We're looking at like 2% contract failure rates across the time, October 2020 through the present, right? So we're doing something different at Chong Miller Group to help to make sure that contracts are durable and to make sure that should issues arise, we're actually getting through those contract problems. If you have an agent who can't help you with that or can't even explain it to you, you really should be finding another agent because they're harming you, right? A failed contract is harm. Okay, so I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. Please have your friends, your neighbors, your colleagues, your family members watch these videos, reach out if you have questions, if you would like some advice, we'd be happy to talk with you. And yeah, smash the like button, hit the notification bell, all those kinds of things too. So I'll see you in the next video. Thanks.